So here I am to talk about the financial markets. Okay, it's a big topic. Can we get that clear? Okay, and in 40 minutes, 30 minutes, whatever, however long you would put up with me, there's only so much I can do. So I am very much going to give you an overview of what goes on in finance. Please realize my perspective is as an economist who looks at the role of the financial markets within the economy and how the economy affects the financial markets and vice versa. So that's my particular perspective. But of course, there's a lot of details involved. And so what I like to do in the first half is indeed give you kind of a big picture. What are these people doing? What's the point of finance? Talk a little bit about particular financial markets and institutions. Talk a little bit about bonds, what a bond is, what a bond market is. Talk about stocks or equity. Say a few words about commercial banks and the role of commercial banks. My own field is international finance. I'll say a few words. But really to kind of give you the big picture. So that then we can turn it over to Rada and Shalini to really give you much more of a practitioner's view. Literally, on the ground, what do we do? What's our job consist of? And clearly there are many, many different people in finance who do different jobs, but they represent two particularly interesting institutions, an investment bank and a hedge fund. And I'm sure you're really going to enjoy hearing from them, just literally what their institutions do, what sort of jobs people have in their institutions, and the particular transaction they're going to tell you about that they've been working on. So I'm very much looking forward with you to hearing from them on that. Okay? All right, so buckle your seatbelt, sit back, let's go. What's the point, really? Besides employing Wellesley College alumni, what exactly is the point of the financial markets and institutions? And it really is very basic. Imagine an economy where you have the following groups. You have business firms. Firms want to grow. They want to have new production facilities, they want to have new products, they want to have new markets. That's investment. But money is needed for investment. And firms only have so much of their own profits they can use. So firms come to the financial markets needing to raise funds. On the other side will be households, people. And these are people who have income, who will save part of their income and think about what to do with their savings. So you have firms that need money to grow. You have households that have money that they want to place. And think of finance as literally a process, not a place, but a process, which brings together those different groups. And so the households are there to give up their savings to the firms, but of course they want something in return. What do they want? Some type of return on their savings. So they get, the jargon is a financial security. It simply is a promise that there'll be some payment over time. And we'll explain what those prepayments are over time. Okay? There's another person who might be at the table representing the government. The government also at times needs to borrow when they run a budget deficit. So a government that is spending more in terms of programs and is raising the tax revenues needs to cover that gap. And the easiest way is to simply borrow from the general public. So again, now you have three groups of actors. You have households with their savings, and they can allocate their savings either to the firms that want to borrow to grow, or to the government that needs money today to finance their own activities. Okay? So the financial markets and institutions are there to facilitate that transfer, that handover of savings from one group of players to another group. Okay? That's really important. It allows people, firms, the government, to make decisions over time and not just to plan for today. So a firm can borrow the money today for a production plant that may not yield money for them for another year, 3 years, or 5 years. But today they can get the financing. People can make plans for retirement, for graduate school, for buying a house, whatever, by going today and starting to save and building up savings that will yield them a return over time. That ability to plan over time is very, very important. So it really is time, which is one of the characteristics of finance, that it frees us from day-to-day transactions and only making day-to-day plans. It allows both people, firms, and even the government to make long-term plans. And that's vital for growth. So as an economist, you said to me, what's the point of this? The answer is that you need to have a financial system if you want your economy to grow. Otherwise, it's never really going to be able to expand. That instead you'll be simply bound by day-to-day decisions. So financial institutions, financial markets, are all part of the process of economic development. And a lot of research has been done in recent decades showing that the more developed a financial system, the better the growth will be of the economy. And very simple economies that don't have any sort of financial system are really constrained because firms can't borrow, people don't have the best way to save, and that really simply slows down the process. Okay? So that's it in a nutshell. That's why they're there, is to help facilitate growth in the economy by simply allocating savings amongst different firms, among the government, and by giving people choices in terms of how they place their money. Okay? All that is very positive and very important, and certainly is true. I would be misleading you if I didn't point out that sometimes things go bad. And so indeed, financial crises haven't been a feature of the modern economy. They became more common in the last decades as we began to deregulate both domestically and internationally. So a lot of my own work is on financial crisis, what causes things to go wrong. So none of this to say that finance is inherently flawed. We're simply saying it's a process. When it works well, it's very important and can really reward both people, firms, and the government. But sometimes things go badly. So as an economist, I would say, it's important to design systems, financial systems, realizing that at times they can become volatile and that markets can go awry. And so it's one of the reasons you need a government. The government to serve as a regulator. The government to serve as a backup when things go bad. Okay? So financial systems can be complicated. Let me be very clear about that. Okay? But again, there's a good point to them, and so you want the best designed system that encourages people to save and is also safe in the sense that it's not going to be subject to volatility. Okay? So that's the point of it. Let's get a little more technical here. Okay? Different types of finance. The most basic one is direct. Direct finance is simply when households themselves take their savings and entrust them either to a corporation or to the government. So they buy the IOUs issued by the firms or the government. The fancy jargon is primary securities. So a primary security is simply some type of security issued by a corporation or by a government, and these can be sold directly to households. And that is indeed direct finance. Problem is, some people are not too happy about direct finance. They find the whole prospect kind of daunting. The notion about having to choose all the different types of corporate securities, different types of government bonds that are available, to choose one of the right ones for my household can be a little overwhelming. Okay? It takes a lot of education to come up with an educated decision about that. So you won't be amazed to hear that some people are kind of put off by that whole process. Luckily for them, there's another way of doing this, called indirect finance. And indirect finance is done by a type of institution called a financial intermediary. So literally, again, think of my story. Here are the households on one side. Here are the firms and the government on the other side. Imagine now there literally being some type of institution in between them. And what that institution will do is to pool the savings of the individual households. So to collect the savings of different households, take those savings, issue the people their own type of securities, called secondary securities, take the money they've collected together, and then use that to acquire the primary securities of the firms or the government. Okay? Those securities that they issue are usually seen as safer by households. So a household that might be a little concerned about putting money in corporate bonds or stock would be much more willing to put money into a bank, because a bank is something we know. There are banks all throughout the economy. You put your money in a checking account or a savings account, it's there. In most countries, it's guaranteed by the government, so that makes it even safer. It's very liquid, which means what? You can get your money like that. These days, literally just use an ATM card. Okay? So financial intermediaries are an indirect way of getting the savings of people who might be a little reluctant to engage in direct finance itself. A mutual fund is another type of financial intermediary. And you should know that companies like Fidelity, headquartered here in Boston itself, is a big financial intermediary. It certainly hires a lot of wealthy college people when they graduate. Again, what do? They take the savings of this household and that household and that household. They issue them shares in Fidelity, in my example, Vanguard would be another, and then take the money, pool it, and they will buy the securities, again, issued by the corporations or the government. You see what's going on? So the people who say, I don't know how to choose corporate stock, are willing to put their money in a Fidelity, in a Vanguard, in a company like that, and allow that company to go out and make the decision. Clearly, the return that you get, the financial intermediary, is based on what they get from the primary securities. So they are acting, if you like, as your agent, and they're investing for you. And their ability to reward you is based on what they earn themselves. So they have to be able to do a good job of choosing the securities. Okay? There are many, many different types of intermediaries. Banks and mutual funds are simply the ones that I think most people see right away. Shalina is going to talk about her company. A hedge fund could be seen as an intermediary, but very different from a mutual fund, very different from a bank. So I'd much rather let her be the one to explain what they do than I try to give you a secondary explanation. Okay? Why are they important? Intermediaries are important because they provide choice. Because households who, again, might be reluctant themselves to save and put them in primary securities are much happier if there's a bank. They're much happier if there's a mutual fund. And that means they're more likely to save. So the amount of savings might actually increase than it would otherwise, but now people have more confidence. That means more savings is available for investment in the economy, and again, that should be seen as a good thing. So this is another example of where financial development can help accelerate growth by simply allowing people to save more, giving them more choices, making them more secure, and that provides more savings to the economy. Okay? So all these security things that we're talking about, what exactly are they? Well, we're going to go into more detail as we go on, but let me give you the big picture. The two most basic divisions is between debt, what we call bonds, and equity for ownership. Okay? Debt, as we'll see in a minute, is an IOU. It's a promise of repayment by a corporation or a government that has borrowed your money. Okay? That money has to be repaid over time. And one division can be between money that will be paid back in 1 year or less, that's called short-term debt, versus money that will be paid in more than 1 year, 2 years, 5 years, 10 years. In the case of government bonds, up to 30 years. Okay? So that would be long-term debt, when there's a promise of repayment and it will be made at some point more than 1 year in the future. Okay? Equity represents ownership, as we'll see. You actually own part of a company. Okay? If you take the long-term debt and the equity, and in a sense combine them together, those institutions and markets are part of what's called the capital markets. So the capital markets is where firms go to raise money for the long-term projects that I talked about at the beginning. Okay? They're there to borrow money, and the money's not coming back for many years in the future. So the money's going to be used for some productive purpose. Okay? By the way, there are long-term government bonds as well. Okay? Equity, again, they're borrowing money to invest in new facilities, and that money won't be available for profits for many years. That's different from the money markets, funny phrase, a market for money. That phrase simply refers to the market for short-term debt. So think of a company that has a payroll coming up in a month, and they have customers. It takes a while to get the revenues out of the customers. You go to the money market today, you borrow the money, you pay your employees, they're happy, and now you obtain money from your own customers and pay back the short-term debt within the next 90 days. Okay? That's a different type of issue, isn't it? That's a timing thing. You know, you've got expenses, you've got money coming in, you're trying to somehow coordinate the two. That's very different from the capital markets. So most of what we talk about will be about the capital markets, where money's being raised much more for long-term purposes. Okay, so that's one division you can think about between debt and equity, and between debt and short-term, between capital markets and money markets. The next division that I'll throw up at you is between primary markets and secondary markets. So what's that all about? A primary market is where a firm will go for the first time to raise money. It could be the primary market in a bond, it could be the primary market in stock. We'll talk some more about it when we get to equity, but it's when a corporation for the very first time goes out and then sells a bond, for example, or selling stock. It gets the money in the capital market, it goes off and does something with it. It engages in some type of productive investment. Okay? So that is the primary market. Once that bond or stock has been issued, however, it then can be sold and resold any number of times. That's the secondary market. Okay? So in the secondary market, it's not the firm who's getting the proceeds, it's whoever it might have gotten initially in the primary market a month ago, a year ago, maybe longer, and is now selling the stock or the bonds to someone else. And so it's those two individuals who are transacting. It's not the corporation. Okay? So why are there secondary markets? Well, because these things are not banks. If you want your money back from a bond, you don't go to the corporation and say, I changed my mind. The corporation says, sorry, you gave it to us, it's in a plant in a field somewhere making profits for us. Okay? So you need the ability to sell the IOU to someone else if you want to recover your money. That's what a secondary market is. It provides liquidity. You're more willing to participate in a primary market and give up your money for some IOU if you know that at a future date you can turn around and sell it to someone else in a secondary market. So please don't dismiss secondary markets as unimportant. They're actually very important. That people need them to give them the confidence that I can go and sell stocks or bonds. The United States has among the world's biggest, most liquid markets. We'll talk about international finance at the end. One of the reasons that so much international money comes here is that we have big markets. And people know that there's always going to be the ability to go into a market and sell something they may have bought at some point in the past. Okay? So that's the difference between a primary and a secondary market. So again, I want to be fair and honest here. Secondary markets can be a bit volatile, which means that the prices can do a lot of strange things. Okay? So yes, the market's there. Yes, it is able to handle transactions, but we'll talk more about bonds and stock in particular. These prices can be a bit volatile. They can bounce around a bit. And so you should know that indeed you are going to be investing. Okay? So that's a whole bunch of jargon. So if nothing else, when you go back to the dorm tonight, amaze your friends as you drop the words capital markets, money markets, secondary markets into your conversation. If nothing else, your parents will be delighted to hear it. Yes, Jessica?
What's an example of a secondary market?
So we're going to talk in a few minutes about the stock market. So the New York Stock Exchange is a secondary market. If you buy stock on that stock exchange, you do not buy it from Apple or GM. You're buying it from someone else who bought the stock at some point years ago and now wants to sell it. So I literally have a picture for you, Jessica, of the New York Stock Exchange. Let's do bonds first. Okay? So again, what is a bond? A bond is literally an IOU, really, with a contractual obligation to repay at the maturity date. So the firm says that I'm borrowing money from you today, I will pay it back, and the date is part of the bond. So again, it's a contractual obligation. It must be paid back. Okay? You know exactly the date, maturity date, and in the meantime, between the initial date and the maturity date, the issuer of the bond has to make payments of interest every year, like clockwork. Again, it's not discretionary. They can't change their mind. And if they did try to do that, you could take the bond issue to court because this is a contract that they are obligated to fulfill. Okay? How do you know? How safe is this company? Are they really able to make those promises of repayment? Well, you can look at the rating. So there are rating agencies that do that type of work. Standard & Poor's, Moody's among the most well-known names. Again, I will point out, I've known a number of alumni who work for those firms. So there's another niche in the financial markets. And their niche is evaluating, for example, bonds of corporations and also governments. Because you can do the same type of analysis with government. How safe is that? Okay? So these companies, these rating agencies, assign ratings, which sounds suspiciously like, wait for it, ratings. Because literally they go from AAA, AA, down through the B's and the C's, down to a D, but their D is our F. D means you're in default. So D means you're not really paying back anymore. Okay? So that's what the rating agencies do. Ratings are very important to the company. Why? Because your ability to get people to invest in your corporation when you first issue the bond is tempered by their assessment of your riskiness. They'll only take your bond, as opposed to a U.S. Treasury bond, which is the safest thing possible, if you compensate them for any perception of risk. So the lower the rating, the more risk there is perceived with the bond. Okay? Therefore, the bond has to issue a higher rate of return to any household or other place that is indeed thinking about buying it. Those bonds which have relatively lower ratings, below what's called investment grade, have two names. The polite name is a high yield bond. The less than polite name is a junk bond. It simply means that they're a bond with a lower rating than other companies, but in return, they offer you a higher yield. Is that a good thing? Yes, if you get the higher yield. But come up, for example, a worldwide crisis, and some of those bonds may turn out to indeed to be risky. That's why they got the low ratings. And there could be examples of where companies can't make their obligations. So there's a continuum of the safest bonds, the U.S. Treasuries, for example. I think Johnson & Johnson has the highest corporate rating. You can find corporate bonds with very high ratings, but then you can go down the list. And if you go down, you'll have other companies which are seen as much less safe. What is best for you depends upon you and your risk aversion. Worry a lot at night? Use a U.S. Treasury bond. Then you wouldn't have to worry about it, okay? Want a little more return? That's fine. You can go down the road and think about bonds, particularly junk bonds, okay? So again, my point is that there's a choice. And you're going to hear that word from me a lot this afternoon. There are choices. And what's good for your household is different from what's good from your household. There's no reason for you to expect the same decision made by different households, okay? Bond markets are driven by dealers. A dealer has a very simple function. She or he makes a market. Now, we can get caught up in bond dealings, but let me give you a simple example. Imagine an art dealer, Newbury Street in Boston, Madison Avenue in Manhattan. What does an art dealer do? They go looking for poor struggling artists, maybe in the Berkshires or someplace like that, or Brooklyn. They find people who are artists, who are creating art, and they say, you know, I think you're going to have a great future. I really like your stuff. I'm going to pay you $5,000 for that particular work of art that you've done. The artist is delighted. They get to pay the rent. Okay? They take the $5,000, the dealer takes the painting, goes back to Madison Avenue, goes to Newbury Street, and does what? adds another zero and makes it $50,000, and then sells it to people as they come in looking for the next hot product, okay? See what's going on? It's the spread. You pay one price, charge another. The bigger the spread, the bigger the profit. The smaller the spread, the less the profit. Think now about art, but think about bonds. So bond dealers are on both sides of the market. They'll pay you one price, but charge another one if you want to buy it from them. And clearly the spread is what will make their profit. So they're buying and selling all the time, trying to profit from the difference. What are bond prices driven by? Interest rates. The rates of return that you can get. And interest rates are inversely related to bond prices. As interest rates go down, the value of bonds that were issued in the past with higher interest rates will go up. Conversely, when rates go up, bond prices will go down. So that's a very important relationship in the bond market. If you're wondering what are bond prices and bond rates been like, let's take a look. Here's the rate of return on Moody's AAA corporate bonds. And you can see if we go back before the financial crisis, they were up to about 6.25. Came down very quickly to 4.5. Came down a lot more to 3.5. And in the last couple of years, they've been kind of bouncing around in this range of 3.5 to about 4.5. Okay? So they go up, they go down. So one of the key things I have to say to you, anyone who claims they know what will happen to interest rates is simply misleading you. I have no idea what will happen to interest rates. You can see they've bumped up recently in the recent past, and some people think that will continue, but that's no guarantee. Okay? Having said that, I was preparing for the talk today. Last Friday, I opened up the paper and see a headline. And the headline is very interesting. The era of low inflation and interest rates may be at an end. Moves in global bond markets over the last few months suggest changing expectations about prices. So there's a lot of talk about inflation going up, prices rising, interest rates rising as well at the same time. And so we may now be in a period in which we're coming out of this period of simply going up and down, and now they're going to go up. Okay? So that is literally last Friday's headline I had incorporated in today's talk. Having said that, if they go down, do not call me, do not complain to me. I'm not guaranteeing that what the New York Times says is going to be true. It simply was an interesting thing to read as I was thinking about our talk this afternoon. Okay? So that's bond prices. Okay? Bonds have a particular function. They are particularly useful because they are fixed income securities, which means what? You know with the bond that every year you get a fixed amount of income. And particularly for older people, that's very important. Okay? So for people who are in the retirement phase, having bonds is great because they know every year, like clockwork, there's some amount of income coming in, and they can simply use that to plan their income for the next period, for the next couple of years. Okay? So particularly for older investors, bonds are very, very useful. Is it possible to speculate in bond prices and take advantage of that? Sure it is. You better have nerves of steel because everything I've ever read about trying to speculate on interest rates means that people can gain a lot and lose a lot really, really quickly. But you're not going to listen to me, so somebody's going to try it anyway. That's okay. I don't mind. Okay. All right. Let's talk about stock. So the most usual type of stock is called, not surprisingly, common stock. If you own common stock, what do you get? You get dividends if issued by a corporation. Why do I say if? Because a company can only do that if they are profitable. No profits, no dividends. Right away, very different world from bonds. With the bonds, you pretty much knew you were going to get that return unless there really was a major disaster. With stock, you don't know. It may be that the company may be simply not in a profitable phase and can't pay off. Or the company may be profits and reinvesting the money to help pay for their own expansion. For many, many years, Apple Corporation was profitable, but not paying dividends. Why not? Because Steve Jobs wanted to plow the money back into the company. Developing your smartphone cost them a lot of money. Okay? So they would take the money they made from selling iMacs and things like that, plow it back in the corporation, and out would come iPhones and iPads and iPods and stuff like that. The day finally came, though, when investors said, okay, we're delighted that Apple's so profitable, it's now kind of time for us to get some money as well. So Apple now is paying dividends. Okay? But right away you can see it's complicated. It's going to be more complicated than a bond. You do get, though, to vote for the board of directors. The board of directors should represent you, the stockholders. And so clearly, by voting for them, you have the ability to express any unhappiness with how the company is being run. That happens sometimes. And you'll see that new directors will be voted in because the big shareholders weren't happy with the current management of the firm. Okay? How is stock issued? The public versus private placement are the two main ways. A public placement is done by investment banks like Goldman Sachs. This is the famous IPO, the initial public offering. And again, I'd rather have Rana talk about this if she wants, because I can only give you a capsule overview. But basically, the investment bank works with the company that wants to issue the stock, and in a nutshell, they'll buy the stock from the company and then sell it to the rest of the world. Okay? So the company doesn't have to go through the process of selling 5 shares to her and 20 shares to her. They sell it as a block, and then the investment banks go out and sell it. Okay? So they're helping facilitate the transfer of the stock from the corporation that is first issuing it to the general public, and that's their job, one of the jobs and things that they do. Okay? That's not the only way. There are other ways of raising money. Venture capital is another niche within the markets. I don't know anyone like personally are venture capitalists, but it must be a fascinating field. Those are the ones to whom, if you don't have much of a track record in terms of raising money, and you don't even have much of a corporation, you make a pitch. And you make a pitch to the venture capitalist that you have a new idea for some product that's going to wipe out the competition. And right now, the idea may be simply something scratched down and in your head, but if they finance you, you'll be able to develop and make a lot of money. I think venture capital must be really hard because you get a ton of ideas pitched at you, and you want to pick the next Apple. You want to pick the next, big winner, the company that's going to do really well, the next Telsa. And everybody claims that that's them, but of course, 99% of the time, it's not going to work out that time. So you're looking for that one home run pitch that you can take and swing out of the park. Okay? Private equity is later on. Companies that might be distressed are having problems, might be bought out by a bunch of people who are both themselves business people and also finance people. So they might take over a company, run it for a couple of years, restore it to profitability, and then sell it again and make profit out of the difference. Okay? So many different ways of doing this. And again, that's one of my points this afternoon. There are many different niches within finance. And that's good, because what would be an interesting job for one person might not be for another, but you can go and look and talk to people and say, what do you do? And what's your job? And you'll see there'll be many, many, many different answers. And the question is, maybe what's the one that's most interesting? Okay? So Jessica, what about that stock market? So imagine stock has been sold in the primary market. So Steve Zuckerberg got his money for Facebook, is all making more money out of it and everything. And now the Facebook stock is out there. And the question is, do you want to buy some? You missed the IPO, but you want to get in and buy some of that stock. You would have to go to some type of place to buy the stock that's already been issued. Traditionally, these were done through stock exchanges. Okay? And the most famous stock exchange really is the New York Stock Exchange. And it really is a place in Lower Manhattan. And I'm quite serious when I say I hope you get a chance to visit it, because I think in my lifetime, and certainly your lifetime, it might be shut down. Why? Because more and more stuff is being done online. It used to be that there were people who would literally stand around, represent prospective buyers and sellers, negotiate, and they would do the job for you. But now you can imagine, that seems really, you really need people to do that? Don't we have AI, So I have no idea if at some point they'll close the place down, it'll be like a temple of capitalism, that your grandchildren will visit one day and say, really, there are actually people down there? There are. And you can go to Lower Manhattan and see them and see what they do. Okay? So there are stock exchanges, but OTC is an over-the-counter market, and there is no address. It's much more of an institution and network, and you certainly understand what that means. So it's much more interaction between dealers who talk to each other online and are buying and selling stocks or something like that. Among the most well-known, the NASDAQ over-the-counter market, which I finally found out after 30 years stands for the National Association of Security Dealers Automatic Quotations. A lot of fancy words. These are simply stocks which are relatively new, are relatively high tech, and so they're not listed on the New York Stock Exchange yet, but they're out there. So NASDAQ is much more the newer companies, the ones who might be the next Apple. We don't know, but they're out there pitching themselves as being exactly that. If you want, though, to, for example, buy stock on the stock exchange, you have to go through a broker. So again, a broker is a different type of institution. They're not dealers, they're not IPO people, they're not investment bankers. They represent you. And so if you want to buy stock, for example, you might go, for example, to Merrill Lynch. A broker there will represent you, will take your order for 100 shares of Apple stock, send that on to their people in New York. The transaction will be made, they'll come back and tell you that, and they charge you a commission rate. So the broker's job is to help you make the transaction either as a buyer or a seller, and their profit comes by simply charging you a percent of the value of the transaction, which I hope you realize is what house brokers do. Here in Wellesley, if you don't know, house brokers are a very big business. A lot of money being made in Wellesley simply buying and selling houses. They're brokers. The same notion. They represent buyers and sellers. They come together. They help negotiate the transaction. Bam, now the deal has been done. Okay? So that's what a broker does. If you're interested in the stock market, you can certainly follow individual companies, which is fine. You might like to follow, though, a broader group, say, like me as a macroeconomist. I want to know, what is the stock market doing? And so if I want to do that, I would follow an average, such as the Dow Jones 30 Industrial, which is 30 of the biggest companies in the US. Okay? The term industrial is a holdover from the 1920s. Some of the companies in the Dow Jones 30 include Microsoft and Disney. They're not industrial, are they? Much more the service economy, but they still have that term. A better measure in the eyes of many people like me who use the data is the S&P 500, which right away you can see where this is going. 500 companies and a much broader selection than 30. Okay? What drives the stock market? I can give you the simple answer and the hard answer. The simple answer is, everybody knows, expectation of future profits. When you buy stock, you're buying into the future of the company. And to the extent that they can generate profits and pay dividends, you're going to benefit. Okay? So how do we know which companies are going to be most profitable? How do we know when is a good time to invest in the stock market? And that gets tricky. Okay? So an academic economist like me would say we don't know. That trying to be a stock picker is very, very, very difficult. Here is the S&P 500 over the last 10 years. You can see how it fell a lot during the global recession, began to recover, stalled a bit in 2015, has been coming back more recently. If you ask me what's going to be like in the next year, I'll be very honest, I have no idea. Okay? It depends on a lot of things going on in the macroeconomy. Oil prices, interest rates, inflation, God help us, the trade war with China. You know, all those things together could affect what the S&P 500 is doing. Okay? Nonetheless, there are people who will tell you they can predict the stock market. So what I'm going to show you next is a real graph I found on the web from someone who claims to be a stock picker. It's not from The Onion. It is a real person who did this. Okay? It took me the longest time to figure out. This is the S&P 500 up to now. This is what he thinks is going to happen to it. It's going to fall, and then it's going to rise. And you can see all sorts of things like high risk and shift of this. And, you know, I mean, I look at that, it looks like a parody. But it really is the sort of things that some people who try to choose stocks will tell you are important. Okay? So my answer to you that is don't go there. But again, people don't listen to me. So if you want to try to be a stock picker and out-choose the market, you certainly can. This is a true story. Went to a party recently of a friend who's an alumna, then another alumna who I've not seen for over 30 years. Says, hi, Professor Joyce, so nice to see you again. Hi, I don't remember this woman. I took your course financial markets back in the 1980s. Oh, isn't that nice? And she says the following, you said to me in class, you can't beat the stock market. Well, I figured out a way to do so. So fine, congratulations, I'm delighted for you. Now, how she does that, she didn't reveal at the party. So I don't quite know what the magic formula is. But if that is your goal in life, to come up to me in 10 years and say that you beat the stock market, God help you, go right ahead, and I'll be delighted to hear if you were successful. Okay? So we're going to wind up with our overview. Got to say a few words about commercial banks. When I was in college, commercial banks, to be blunt, were boring. B-O-R-I-N-G, boring. Why? They were heavily regulated. A bank could only operate in the state, and even in some states within some areas. And the only thing they could do is to make short-term corporate loans. That was it. That is what a bank did. It was a very, very simple industry. Along comes the 1980s, 1990s, and they deregulate. All of a sudden, everything changes. Banks can grow. So now I have my account at the Bank of America, which when I was in college was this esoteric thing out in California that I read about, called the Bank of America, and now here they are in downtown Wellesley, along with the Santander Bank, which I hope you know is a Spanish bank, which has been allowed to operate in the US. Believe me, that's very different from a generation ago. And what banks can do is change. And so it had been a very firm line between commercial banking that took your deposit, made a loan to a corporation, versus the investment banks that did the IPOs and other things. That line now has pretty much been erased. And now you have institutions that can do both types of things. Okay? So banking has gotten very different. And now the opportunities for what people have done has changed a lot. Among the things that banks learn to do is called something that has the great phrase, securitization, which means they can take a loan, turn around, package it, and sell it. And that's great for the banks because they get them off the balance sheets and get money for them. But they kind of overdid it in the last decade. And we wound up having mortgage-backed securities that were not always particularly good things to be buying, being sold extensively. And the result, in part, was the global financial crisis. Having said that, securitization by itself is not a bad thing. It's a perfectly sensible thing to do. But again, to go back to where I began, you got to have good systems in place, you need safeguards, et cetera, et cetera. Okay? So that is what commercial banks do. And we'll end with my own field, international finance. Up to now, it may seem like everything I've said refers to only within an economy. But that's not true. Money crosses frontiers. People buy foreign stocks and bonds to diversify their portfolios. Firms engage in foreign operations to lower costs and into foreign markets. That's called foreign direct investment. Okay? Banks certainly make international loans. I said to you already, Santander Bank is here. US banks are over there. Okay? So international finance, my field, has grown also greatly in the last decades. And I will tell you that in my work, I find more and more that domestic markets, financial markets, are much more becoming globally integrated. When there's a change in the US in financial markets, there are reverberations like that around the world. Realize that over a 24-hour cycle, when the US is closing down, Asia is opening up. When Asia is closing down, East Europe might be opening up, or Russia, or then Western Europe. When they close down, of course, the US is opening up. So there's always that cycle going on of financial markets opening up and responding. And if there is a major event in the US, that will have an impact around the world as these other markets respond, and vice versa. We will respond to oil prices, which is a foreign event that happens in our economy, has an impact upon us. Okay? So international finance is a different world unto itself, but I would make the claim it is a growing world, and that it's very important to understand that. And you really can't do finance without understanding international finance. Okay? All right, you've suffered enough. I'm going to stop. Okay? If you still have any interest in this, let me suggest one particular book done by a man called Mark Levinson, who was at The Economist magazine for many years. And like everybody at The Economist, he's a very good writer. And this book is called The Guide to Financial Markets, Why They Exist and How They Work. They're up to the 6th edition, which should tell you something. It's relatively cheap, it's a paperback, and I think it's something you can get you can get online very easily. I even think our library has a few copies, so it's pretty much out there. It's pretty easy to get a copy of it if you read it. Okay? So let me say two things at the very end, and then I promise to stop. Number one, I'm delighted to be asked by Stephanie and to join Rod and Charlene in doing this. In the following sense, if this is something you want to pursue, okay, I will certainly be happy, as I did this afternoon, to try to give you some of my knowledge to help you build upon it. Okay? But that's only if that's what you want to do. I would never want any student to think that somehow I'm saying, oh, this is what you should be doing. What you should be doing is what you want to do. Again, if this is what you want to do, that's fabulous. There are some great role models, there are many other people out there, but I've known just as many alums who started in finance and then decided to change fields. And you know what, from my point of view, that's fine. I have no agenda here. I simply want students and alumni to find the professional work that they find most rewarding. Okay? So I'll be very clear on that, because I read things in the student paper that Wellesley students feel pressure to go into finance, not by us, not by the faculty. We'd love you to become professors, but we don't ask about that. So the point is that I will only talk to you if you want me to. I would never say, oh, this is the best thing. It might be the best thing for you, but you have to tell me that. And if you do, I'm happy to answer your questions. And if you say, no, Professor Joyce, I'm going to write the great American novel, seriously, that's great, if that's what you want to do. The second thing on that may seem to contradict it. Again, I don't care what you do professionally. I do think you should know this. I think you should know this as a person, as a woman, to be very precise, okay? Because for years, financial decisions were not entrusted to women. Those days are over, okay? I handle my mother's finances, she's still alive. I'm happy to do so. I handle the Joyce family finances because my wife, who I love dearly, has no idea how to balance a checkbook. The Joyce children have to know how to do that, because there are 2 Joyce children, we're your age, okay? I can't promise I can handle my girls' finances for them. So they have to learn, okay? The same is true of you. As much as your parents love you, have taken care of you, at some point you need to make these decisions. It's not that hard. I've taken half an hour of your time. Already you have a rough idea. Oh yeah, there's bonds, that's one thing, stock, that's another thing. You got it. It's not that hard, it's jargon. And if you can sit down and learn that jargon, you can pretty much learn to make intelligent decisions. So again, professionally, that is your choice. Personally, you should know this. You should never allow someone else to make these decisions for you. Because if you're at Wellesley, you can learn this, okay? And I've spent 30 years watching kids learn it, and I know that each of you can do it as well, okay? So thank you very much for your patience. I appreciate it.